How to make millions in crypto even when price is boring. You saw many advertisements during the Super Bowl that related to cryptocurrencies, and you might have thought them strange, or profoundly dystopian, or just eerily familiar. Despite this, you may think the blockchain still has untapped financial potential and wish to invest in it. Alternatively, you might already have part of your money invested in cryptocurrencies through services like Coinbase and FTX, which had advertisements during the Super Bowl. What shall we do now? A full-time career is possible for those who choose to actively trade on cryptocurrency price variations while also monitoring the ebbs and flows of Bitcoin, Ethereum, and other digital assets. Trading during the day, in essence. And for many people, getting started with NFTs, which are digital baubles you can mint, buy, or sell, is still an intimidating prospect. There are several other ways to make money on cryptocurrency that are just sitting in your crypto wallet, such as staking and yield farming on Defi networks. These are options that are available to many cryptocurrency traders who are in it for the medium to long haul. The phrase decentralized finance, sometimes written as DeFi, refers to pretty much all of the services and tools that are based on blockchain and are used for digital currencies and smart contracts. Staking cryptocurrency and yield farming are, at their most fundamental levels, essentially the same thing. They both entail depositing money into a crypto coin or multiple crypto coins at the same time, and earning interest and fees from transactions made on the blockchain. Farming based on staking versus yield. It's not hard to stake a claim. Typically, this entails keeping cryptocurrency in an account and allowing that account to accrue interest and fees while the monies in the account are being committed to blockchain validators. When validators on a blockchain support transactions, a portion of the fees that are produced are distributed to stakeholders. Because of the extreme popularity of hold for interest strategies, even big cryptocurrency dealers like Coinbase now provide customers with the option. Some tokens, such as the extremely stable USDC, which is pegged to the US dollar, give interest rates of approximately 0.15% per year, which is not too far from depositing your money in a bank in a checking account with a low interest rate, while other digital currencies may earn you 5 or 6% per year. Some services demand staking, which locks up funds for a particular period, meaning you can't deposit and withdraw whenever you want, and they may require a minimum amount to draw interest. This means that you can't deposit and withdraw whenever you want. Farming with a yield is only a little bit more difficult, but it's not that different. The addition of funds to liquidity pools is typically accomplished by yield farmers through the simultaneous pairing of more than one type of token. For example, a liquidity pool that combines the Radium token and USDC would produce a hybrid token that can generate an annual percentage rate, APR, of 54%. That looks like an impossibly high amount, and it gets stranger from there. Some newer, extremely volatile tokens might be a part of yield farms that give APRs in the hundreds of percent range and APYs in the 10,000 to 20,000 range. APY is similar to APR but considers compounding. The incentives, which are accrued continuously, are typically distributed in the form of crypto tokens that can be mined. These coins that have been harvested can either be taken and converted to cash, or they can be reinvested in the liquidity pool and added to the yield farm to receive larger and more rapid payouts. If you think something is too wonderful to be true, you're probably right. Staking is a less risky form of farming than yield farming. The tokens that are currently offering such high interest rates and fee yields are also the ones that have the most potential to suffer a significant decline in value if the underlying token suddenly experiences a significant drop in value. There is a phrase for this kind of loss. It's called permanent loss. Even if you make a lot of money on fees, the value of the token on the market could cause the amount of money you invested into a yield farm to be worth less when you finally decide to withdraw it. A few of the DeFi providers on the market offer leveraged investing, which is an even riskier financial strategy. When you add a multiplier to your yield farming investment of 2, 3, or more times the normal amount, you are, in essence, borrowing one type of token to pair with another and paying a collateral that you hope will be recovered by an increased annual percentage yield. if you make a bad bet. However, your entire position may be liquidated, and you would only receive a portion of what you had initially invested as a return. Those who are just starting in yield farming should steer clear of low liquidity pools. In the field of decentralized finance, this is assessed using a metric called TVL, which stands for Total Value Locked. This metric will tell you how much total money is invested in a specific liquidity pool, currencies, or exchanges. In addition, just like any other kind of digital network, DeFi services are susceptible to being hacked, having poor programming, and experiencing a variety of other hiccups and issues that are beyond your control. Monitoring the value of tokens and switching from one sort of yield farm to another can get you decent results, but it's similar to attempting to time the stock market in that it requires a lot of work to get passive money. It is possible to be exceedingly hazardous, and success may depend on luck more than on ability. How to get started? If you are interested in getting started with staking or yield farming, the first thing you should do is check to see if a cryptocurrency exchange that you are already using provides these choices. Binance, FTX, Coinbase, TradeStation, Kraken, and other financial services that deal in cryptocurrency may provide staking of various currencies. These currencies include Ethereum, Tezos, Polkadot, and Solana, among others. On the yield farming side of things, some of the services that offer the option to exchange tokens, add to liquidity pools, and invest in yield farms are PancakeSwap, Curve Finance, Uniswap, SushiSwap, and Radium. Other services include SushiSwap and Radium. Typically, you may access them using crypto wallets that connect to the service and provide you the ability to add and remove funds from your wallet. Gains from yield farms can be highly unpredictable, and the emergence of new tokens offering extremely high APY rates can frequently entice new yield farmers into pools that swiftly pump and dump their holdings. However, many investors who are holding cryptocurrency money for an extended period are discovering that staking and yield farms with more stable coins are another weapon in their toolkit for generating a return on their holdings. Invest and hold on to it. This is by far the most prevalent strategy for profiting from cryptocurrency investments. The majority of investors purchase cryptocurrencies like Bitcoin, Litecoin, Ethereum, and Ripple, among others, and then wait for their values to increase. Once the prices of their goods have increased on the market, they can sell them for a profit. This method of investing requires one to recognize assets that are both more stable and more volatile, to generate consistent returns from the former and the latter. Bitcoin and Ethereum are examples of assets that are known to keep consistent price movements. As a result, they can be regarded as secure investments in this context. You are, however, free to trade any item that you believe is going to increase in value. The only thing you are required to do is research each asset you invest in before deciding whether or not to HODL it. Additionally, it is not necessary to purchase the most expensive assets to make a profit. There are thousands of minor cryptocurrencies that have decent price swings. You should think about having a mix of all coins that have a promising future worth and are not just popular in the exchanges. Consider having a mix of all coins that have a promising future value. Do you like it? Kindly give your valuable response in our comment section below. And don't forget to subscribe to our YouTube channel for more interesting and informative videos.